He said in a call that, quote, nobody in history, as far as we can tell globally, no other global consumer retail bank has been able to build a multi-country platform that is extremely efficient, that has one code base that ultimately could give them a significant advantage in expanding. And that's what we've been building for about 18 months already, and probably have another 18 to 24 months. And is something that will continue maybe forever, is having a proprietary core banking platform that allows us to be in multiple countries and allows us to launch in new countries with relatively low investment. And if you want to be really bullish on Nubank, you could argue that they have a potential to take over all of Latin America at scale with low costs. And if anyone is going to do that, it's probably going to be them.
Before we begin today, Shawn and I would like to make a special announcement. We are launching a new private investor community devoted to intrinsic value. And we are opening up 30 spots to the public. The community will be dedicated to sharing and giving feedback on investment ideas, networking with like-minded investors, exploring our curiosity in the investment world, and it includes the opportunity to join calls with famous experts. It's going to be a popular offering, so to secure your spot, head over to theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. You can also find that link in the show notes in the description of this episode below. And with that, let's get to it. Today, Shawn's pitching an innovative fintech company out of Brazil, one that is growing incredibly fast and promises to revamp how much of Latin America banks. Whenever financial firms are growing quickly, that's famously a red flag to look out for, because they may be aggressively taking risks that other banks and lenders are just not willing to take, setting themselves up to be at high risk of blowing up. Shawn, I'm sure you will help us better understand Nubank's growth prospects today and the risks it's taking. But as just the last thing I will mention before throwing it over to you, what has really brought our attention to this company is the fact that Berkshire Hathaway has been an investor in it for several years now. The company is very much outside of the usual Buffett playbook, so that alone makes it interesting. Plus, how often do you get to say that Warren Buffett and Cathie Wood are betting on the same company?
Hey, Daniel, good to see you again. I feel like we just saw each other. Speaking of Berkshire, we just both got back from Omaha for the Berkshire shareholder meeting. So that was a great time. And yeah, this is a company that I'm kind of presenting today based on popular demand, I would say. I cannot tell you how many people have recommended Nubank to me over the last few months and asked me to cover it on the show. And I know at least in the Blue Owl and Visa episodes, I've kind of complained about having to cover financial services companies. And yet here I am pitching Nubank today. And whether or not we decide to actually invest in Nubank, part of the reason I'll say this up front that I want to pitch it is to push myself out of my comfort zone. Not only is this a fintech banking company, but it's a foreign fintech banking company, meaning I'm even less familiar with the regulatory laws affecting them, to say nothing of the fact that I've never used their service, don't know anyone who's ever used it, and, well, I'm not an expert on Latin America, which is primarily where they operate. So with those caveats just right out there, I'm about as far outside of my circle of competence as it gets, with the exception of maybe pitching some biotechs or nuclear energy companies, which I can say with pretty high confidence I will never pitch on this show because I can't even pretend to understand what they're working on. But just setting that aside, and with that maybe inspiring backdrop, the question people are probably wondering is, why on earth am I pitching Nubank then? And like I said, in part, this is simply to push myself outside of my comfort zone and maybe do the same for much of our audience. And honestly, it would be lying to say that I would be interested otherwise if Berkshire hadn't invested in it, right? Berkshire is one of the big drawing factors where I at least want to understand what was going on here, because it was so beyond their normal playbook. And as much as we would like to think of ourselves as being completely independent thinkers, I have no shame in saying that when the world's best investor invests in something, or at least when his company does, I take a look. And well, unsurprisingly, there is a ton to be excited about with Nubank, which we'll get into.
I think there's no shame in taking inspiration from great investors for new ideas. What matters is that you're not just blindly following or cloning what they do. We need to understand why the investor makes that decision. And to understand that, you probably need to know more about the company, and then you can see, do you agree or disagree with that decision? That might be a bit difficult in this case, since it's very likely Buffett didn't make this investment himself. Not only is it far out of his circle of competency, as well as yours, the initial investment has also just been $500 million. For Berkshire, that's such a small amount that it just seems unlikely Buffett was the one behind that investment. After visiting this year's Berkshire meeting, the Nubank investment seems even more surprising. I think both you and me were kind of surprised how often Buffett brought up currencies in this meeting and the huge risks that come from investing in unstable currencies. And South America is known as a place where currencies are volatile and they can devalue quite significantly and in a short period of time. It happened to the Mexican peso in the 90s, the Argentinian peso just recently, and also the Brazilian real in the 2010s. And perhaps that's one of the reasons why Berkshire just recently sold more than half of their stake in Nubank. And it's another example for why you should understand an investment and a company and not just copy the investment because you saw it by Buffett or Berkshire taking a position. The investor that served as your inspiration can sell the position any day, so you should know the position yourself well enough to make an investment decision. So let's find out more about the company so that we don't fall into that same trap. Tell us, what is Nubank, and besides Berkshire, why should we care about them?
Nubank is a digital bank, and in over just a decade, it's actually become one of the biggest digital banks on the planet. And as a digital bank, they have no physical branches, obviously, which makes them almost more of a tech company than a traditional bank. If you think about it, banking should be one of the most profitable businesses in the world. You can scale lending and deposit services to a massive degree if it's all done digitally. But the cap on a bank's ability to scale their business has always been that with more customers comes the need for more physical branches and more people to man those branches. And that, overlaid with regulatory restrictions, limits how much banks can actually grow and how profitable that marginal growth is. And with Nubank, they obviously have a huge structural profitability advantage by being digital first. And the question from there is really, why are they able to do that? Why are they able to be a digital first bank? And before I answer that, I want to make sure I don't bury the lead here, which is to say, this is a company with over 100 million customers, with over 90 million of those being in Brazil, such that something like 60% of Brazil's adult population uses Nubank in one way or another. And that is just incredible. And now they're quickly expanding in Mexico and Colombia, and there's some speculation about Argentina too soon. So they have found this powerful formula for success that is clearly loved by users. Otherwise, they wouldn't have these insane adoption rates. And there's good reason to think, at least if you ask the bulls, that they can recreate this playbook across much of Latin America. And if so, I can already tell you the stock is undervalued.
That's for sure. I mean, those adoption rates speak for themselves. They've clearly found a product market fit that is almost unprecedented. And here in Europe and even in the US for you, this wildly successful business isn't something we would otherwise be privy to. They don't operate here, and yet they're eating up market share in a part of the world that is very quickly developing and has a real need for more financial services that we probably take for granted every day in our lives here. But I did want to make sure you answered that question, which is, why are they able to be a digital bank? I'm sure every bank would want to be a digital-only bank if they could, since that's a way more profitable business model, where you're relying more on software than investing in branch locations and the people who run those branches. It's just way more capital intensive.
This is one of those classic cases where it actually pays not to be an incumbent, I would say. Most banks around today have been around for decades, even centuries. And only recently has it become possible to run a banking business at scale from a digital foundation. And of course, most of Nubank's competitors are designed for this legacy system of banking, 20th century banking. We always end up, in some way or another, talking about the innovator's dilemma, but this is yet another instance of it. they're used to doing what they've always done. And the average bank isn't exactly what you'd call an early adopter of technology, right? This is not their circle of competence. They know a ton about underwriting loans, building relationships and communities, and more stuff like that, but they aren't exactly able to design 21st century financial products that are digitally enabled. For example, up to like 2 or 3 years ago, my bank's app was terrible, like almost unusable. And this is not a small financial institution. With the point being, most banks are built on archaic and slow-moving infrastructure. And the types of people who work there aren't traditionally the highly innovative tech bro type that you might imagine. So as a new entrant, Nubank has had the chance to build a financial services business completely from scratch, with a focus on being as scalable as possible thanks to being digitally native. And Brazil was arguably the perfect place for something like Nubank to emerge, because you had this oligopoly of powerful but also really complacent and stagnant banks that dominated the local market. Yet they were only focused on serving wealthier customers. And by doing so, they left this massive cohort of people unbanked or at least underbanked. And as Brazil has quickly developed in the last few decades, there's a serious disparity in banking services and income. And on top of that, you have one of the largest online populations in the world. Brazil actually has the third most social media users on the planet, with 80% of the population having smartphones, while usually ranking first or second in internet usage per person. So to recap, you've got a country dominated by a few stagnant incumbents, a large population of unbanked people who are quickly getting much richer and are very frustrated with existing banking solutions, and then world-leading rates of internet usage. And of course, all of that combines together to show why I say I'm not that surprised that a digital bank like Nubank could emerge in Brazil and be so disruptive and have so much success. And that's not to say that Nubank's success was inevitable, but you can see how the opportunity came about.
One of the things that we know for developing countries is that they don't exactly embrace technology linearly on the same path that already rich countries did. For example, in the last 5 decades or so, here in Germany, we've gone from checkbooks to credit and debit cards, and then PayPal and Venmo. And it's the same for you in the US. And when you have countries that are now becoming rich enough to take advantage of cutting edge technology, they make what looks like a very sudden leap in technology. Someone in Brazil, thanks to Nubank, might go straight from only ever using cash to now not only being banked in a way they weren't before, but doing it completely digitally, without that feeling weird at all to them, since they may not know anything else. We've discussed a lot of this in our Visa episode not too long ago. In the US and Germany, you have this inertia where people are used to having done things a certain way for so long, like going to physical bank branches or paying bills by mail, that it can just take some time for the average person to adopt more to cutting edge features. Whereas in some place like Brazil, for example, everyone can make a big technological leap at once whenever a company like Nubank is coming and is willing to make it available to them. That's kind of where it all starts. There has to be a company enabling those features, and then the consumer will follow.
Exactly. And I should add that this is literally a kind of a David and Goliath story, which is a play on words because Nubank's founder and CEO is named David. But basically, the 5 biggest banks have had, and really still have, a stranglehold on the Brazilian market. And I think they wield something like 80% of the country's total banking assets, while providing notoriously terrible customer service and almost abusing customers with these sky-high interest rates and fees. We're talking 450% interest rates on credit cards, which are by far the highest in the world. So just, of course, all of that was ripe for disruption. And like I said, lending rates in Brazil are the highest in the world. And I think it has something to do with the concentration of banks in Brazil, where the US has thousands of large and small banks across the country. Brazil, which is a country of a similar population size, has only a few hundred different banks. But only in hindsight does this all look obvious again for Nubank. Flashing back to 2013, David Velez, who co-founded Nubank and is still the CEO, was going up against these massively and deeply entrenched competitors. And everyone thought, hey, you're a fool for trying to change the system because the rules aren't exactly fair. And I actually want to take a minute just to play a clip here from David describing what initially spurred him to try and create a rival banking company. So let's listen.
I was enamored with financial services. I had spent a lot of my career in financial services. And I had also felt the pain of financial services. When I moved to Brazil, I had to open a thing called a bank account. And it was a horrible experience. I had to go to one of the biggest branches in Faria Lima, which is like the center of financial services in Latin America. And I was so surprised about how hard it was to get a simple bank account. I had to go into this banking branch that had bulletproof doors. There were a lot of armed guards that asked me to leave the branch and leave my backpack in a locker and then walk back in and wait 45 minutes for a branch manager to throw a bunch of paperwork at me and then start this process of 5 months trying to open up a simple bank account. And there was so much anxiety and frustration and pure rage about how hard it was to get a simple bank account, to then pay some of the highest fees and interest rates in the world, that I didn't understand how it was possible that Brazilians were putting up with this. How isn't anybody competing with these big banks and offering better solutions?
So a few banks in Brazil had consolidated power and used that power to manipulate politicians and rewrite regulations to their advantage, creating just a really terrible experience for consumers in the meantime, who were really at the bottom of these banks' priority lists. And for Nubank to enter that competitive environment and come out with 100 million customers 12 years later, completely from scratch, there's no words for it. It's breathtaking. And we'll get into the financials more, I'm sure, but they're doing this all much, much more efficiently than their peers too. And unlike a lot of Silicon Valley companies that scale up quickly, they didn't splurge billions of dollars on marketing. And maybe that's because they're not truly a Silicon Valley company. Most of their customers, something like 80%, have been acquired completely organically through word of mouth referrals. And the advantage here of being digital is the shared economy scaled model, which is something we've talked about a little bit before, where they can pass on much of their cost savings to customers, offering more attractive products like credit cards with maybe lower interest rates and competitors. And all of that spins the flywheel faster by attracting more and more customers, giving them more scale that further improves their operating margins and allows them to pass on even more benefits to customers. And it just keeps going on and on and on. And like I said, that begins first and foremost with the fact that they're a digital first bank in the way that much of their competition isn't. And if you think about it in manufacturing terms, they've created a moat around their business by being a low cost producer with much less overhead than their competition, and even so relative to banks in the US. And when you look at a company like Amazon, you could probably argue that they also benefit from network effects on top of this, but really first and foremost, they won by being a low cost producer. And if that's an advantage you can continue to compound as you scale, as I think Nubank has and will continue to be able to, well, that's just very, very attractive.
It's a huge advantage they have. And it's a pattern that we see in so many of the great tech compounders. And it speaks for Nubank's product that 80% of customers come just by word of mouth, referrals only, basically. This really feels like one of these spot a problem and then solve it companies. While most companies should be that way, in more developed markets, I often get the feeling that the problems left to solve are kind of on a margin, and the big leaps are coming unexpected and kind of unasked for. Think AI, for example. But it's not only about seeing the need, you also need to solve it. And Nubank succeeded in growing underneath the noses of these big and powerful legacy banks. And I gotta ask you, how did they do that?
So they started out with a simple product. These credit cards with no annual fees, and then, like I said, comparatively low interest rates. And within a relatively short period, they had a few million customers. And from there, they began to expand into these other banking services and debit cards. And while they knew they wanted to ultimately disrupt the banking industry, there were all kinds of rules meant to basically squash competition, like the specification that new firms that had foreign investors couldn't get banking licenses immediately. And yet that rule didn't apply to credit cards, obviously. So that is where they started. they kind of found a regulatory loophole and used that as an opportunity to offer a superior product in terms of having no fees, but also in terms of having a much smoother onboarding process that could all be done by smartphone, which was sort of unheard of in Brazil at that time. And in part, that's how they grew in the shadow of these big Brazilian banks who would have otherwise tried to kill any competition because they weren't exactly a bank yet. And they were doing something that's so different and foreign to what these banks were doing. It was just not truly a pure competitor. But over time, as was the original plan, they've expanded further into insurance products, small business loans, investment management, and all of these tangential financial services. But as I said, they started simply with one really good, sleek product that set the stage for the exponential growth that we've seen. I should add that in 2016, when it did become clear that Nubank was a threat to Brazil's banking oligopoly, it's not like they didn't do anything, right? They did try to crush Nubank. They tried to change the regulations around when merchants are paid, such that Nubank would have to tie up billions of dollars in working capital to basically complete payments 30 days sooner. And that was an existential risk for not only Nubank, but really any new competitor trying to offer a competitive product with big banks. Unless you already had a large scale, it was just going to immediately become impossible to come in and compete. And when the word spread that Nubank may cease to exist because of this rewriting of the rules, thousands of Nubank customers rallied around the brand and started sending letters to politicians, making viral videos online, telling others about what was happening. And you just had this massive social pushback that actually worked. Regulators saw that uproar and they ended up taking consumers' side. And they decided from there not to push forward with this new rule that would have effectively killed Nubank at that early point in history. And that is what really cemented Nubank as a competitor in Brazil.
If you enjoyed this show, I would bet that you would love our Intrinsic Value community. It's a private network for sophisticated long-term investors who care about deep research, sharing actionable investment ideas, and making meaningful connections with like-minded individuals. Besides reading all the value investing books I could get my hands on and doing my own valuation work, nothing helped me more than getting feedback from a group of sophisticated investors with diverse backgrounds and distinct circles of competencies. We also host calls with a variety of experts and investing professionals who share their unique strategies and insights with our members. But we are only opening up 30 spots for a limited time. They will probably fill up fast, so if you want to invest better and surround yourself with people who do the same, you should join our waitlist for the Intrinsic Value community at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community.
Hey guys, this is your host of the Intrinsic Value Podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. We are value investors. That's the whole point of this show. So of course we love to make a little extra money. And for someone who loves to travel as much as I do, like I just did to Austin, Texas for a friend's wedding, you really need to take advantage of all the small ways to make a little extra money when you can. Fortunately for me, and for anyone who travels frequently or has a second home, using your house as an Airbnb to earn income with is the easiest it's ever been, thanks to Airbnb's new co-hosting network. All I had to do was provide the space, get paid, and they handled everything else. It's that easy. With Airbnb's co-host network, you can hire a sophisticated co-host to take care of your home and guests without the stress. One of my childhood friends' family owns at least 2 vacation homes that I know of, one in the mountains and one at the beach, and it blows my mind that they don't list their home on Airbnb as a way to monetize those properties that are, well, let's be honest, empty for most of the year. They would be the perfect candidate for working with a co-host through Airbnb. If you have a second home, travel often, or are away for extended periods of time, go find a co-host at airbnb.com/host and start earning extra money today.
Wow. I mean, we've talked about a lot of cool stories and corporate histories on this podcast already, but this is maybe the most inspiring story we talked about yet. And that underlines the point that Nubank really solved and still solves the problem. Customers love it, and because of that, they fought for keeping it alive and in place. I guess that's the only way to stand up against these giant legacy banks that I would expect are pretty well connected in politics in Brazil and usually get what they want. You have the situation where the odds are completely stacked against new entrants to the detriment of customers, and then Nubank leads kind of a revolution of the masses, if you want to say that, that completely changes the status quo. It sounds like they pushed the government to go from catering to the banking oligopoly to catering to consumers. Once consumers realized how badly they had been mistreated after having gotten a taste of a much better experience with Nubank, they kind of realized this is what we want to keep. And I think many companies start out that way, that they go niche first, and if the product is good, they then start expanding into different products and become a bigger company.
All of that, plus the best part for this company is David Velez, who led that revolution and established Nubank's customer-centric culture. Not only has he built what I would say is an incredible business from nothing and improved the lives of obviously tens of millions of people probably, but he has shown that he just isn't in it for himself in the way that you might expect. And he's actually been willing to forsake some of his personal gain for the company's benefit, which we've studied a lot of CEOs. I'm not sure how many other CEOs would sacrifice their personal wealth in the way that David has for the greater good of the company. And basically what he did is he gave up this variable compensation and contingent share award from 2021, just to use the kind of legal jargon of how it's described. And by giving those funds back to Nubank, it's estimated that he saved the company over $350 million and basically 2% shareholder dilution over the next 7 years. So again, how many people would leave that kind of money on the table to support what's in shareholders' best interest at a time when there were some concerns about how profitable the business could be? And so don't get me wrong, he's a billionaire, so this isn't completely charity, but the point remains. And to invoke one of our favorites, Charlie Munger, as he once put it, we look for people who would be working even if they didn't need the money because they care about the mission of their company. And I think as the founder who also still has a 20% stake in the company and who has led this revolution and did something very, very bold, I mean, who cares about the future of Nubank more than David Velez? I mean, he's just exactly the right person you'd want to have running the company. So I think actions tend to speak louder than words. And in this case, his actions speak very, very loudly.
Nubank seems to have so many of the key characteristics that we see in all these successful US tech companies. A new and disruptive business model that works very capital light compared to the legacy players, a flywheel where those advantages are passed on to consumers, at least to a large extent, as we've seen with Amazon as well, and a founder and CEO who thinks long-term instead of just quarter to quarter and is willing to leave some money on the table if it benefits the greater good of the company. Since you know the company better than I do, perhaps let's pull the thread further on what David has built with Nubank and what advantages it actually has. You mentioned that lower costs were something of a moat for them. Can you tell us more about the lower costs and any other advantages that you think they have which will benefit them going forward?
I should really hammer in the point of their cost advantages of starting from scratch as they did. Right. My understanding is that traditional banks in Brazil have just been very slow movers in adopting technology. And that's because they have tens of thousands, and in some cases, actually over 100,000 employees and hundreds of branches with this patchwork of IT systems and software tools that have been mashed together probably over several decades. And the result is you get these behemoths that just cannot move nimbly. And as an example, if you lose a credit card at a traditional Brazilian bank, at least within the last few years, you would have probably been going to get a case number. You would have had to fill out a bunch of forms. You would be mailing them in, and then you would have to call back in a couple of days to kickstart the process just to get a new credit card. That's not true in every case, but the point is that those kind of things have gone on pretty recently and may still even go on from what I've heard. And whereas with Nubank, it is as simple as a few clicks of a button in their app to get a new card sent to you, which is really how it should work, right? And when you aren't carrying a ton of bureaucratic inertia, it's much easier to design something that isn't just a better product, but is more efficient and thus cheaper to scale than the alternative. And while the big banks are on their back foot trying to catch up, Nubank is getting more and more customers at their expense, and importantly, getting more and more data on customers that it can use in their underwriting decisions. So they aren't necessarily growing irresponsibly, right? They're getting data on lending and on the platform and customer habits and just creating a better and better product over time. Anyone can grow quickly by offering cheaper loans, but then at the same point, that business model falls apart when your questionable loans don't get paid back. So that is really the challenge I should emphasize for fintechs. And for Nubank, they've got the tech part down, and that helps a lot with adoption and scaling. But from an investor's perspective, you want to be certain that this isn't all going to blow up either.
The more companies we cover, the more you just see these patterns emerge. And data is really one that no matter what company we cover, it's so powerful to have data on customers that those legacy competitors, in this case, the banks, just don't yet have. It helps with expanding the business, but it also helps with the unit economics of the current business. And I still want to ask you about all of that more in a moment, but given the old adage about never investing in fast-growing financial companies because of all the hidden risks that might be there, and this is a company that has grown extremely fast in US dollar terms, but actually even faster in local currency terms. I think the Brazilian real depreciated by over 20% last year against the dollar, and that has understated their still phenomenal growth figures when you look at the results in dollar terms. So we are talking about a company that has grown revenue by an average of 75% per year over the last 5 years, and probably it has been even more in real terms.
And a weak real is one of those risks with investing in Nubank from the perspective of an American or European. But to get back to that original question on moats, I think innovativeness and flawless design and good execution are all subtle cultural advantages for them, but not necessarily deep moats. To the extent those things help Nubank recycle cost savings back into benefits or customers, maybe that's one thing and arguably is a moat, but otherwise, I don't really see any clear moats here. And then there are those currency risks that we just talked about. But sometimes all you need is one good moat. And more broadly, just to take a step back, people typically say there are 5 types of moats: low cost production, high switching costs, efficient scale, network effects, and intangible assets like branding. And I'd say switching costs aren't terribly high in this case because it's really not that hard to close and open other digital bank accounts or even to close and open new credit cards. It's a hassle maybe, but it's not terribly difficult. And then additionally, there isn't really a network effect here in the traditional sense. Nubank isn't necessarily a better product for me due to the number of people who use it. I will say, however, they have reached an efficient scale, obviously, that helps with their low cost advantages and actually comes with another advantage in that they're really as big of a bank as any in Brazil now, and maybe systemically important. And that does come with some probably favorable regulatory treatment. But still, ultimately, the thesis here for any advantages Nubank has ultimately comes down to just having a lower cost structure than all of their competitors. And some estimates suggest that Nubank's operating costs maybe as much as 85% less than its peers, mostly due to not having those physical branches and having a fraction of as many employees. So when I say a low cost advantage, I mean, that is what we're talking about, 85% less in some cases. And per client, expenses can be 13 times higher at traditional banks. And the cost of acquisition, by some of the estimates I've seen, can be as much as 60 times higher for them. So traditional banks in Brazil have something like less than 1,000 clients for every employee, while Nubank has closer to 9,000 clients per employee. So no matter how you chalk it up, and by any measure, it's just dramatically more efficient, and maybe 15 to 20 times as efficient in some cases.
Wow. I mean, I figured that they would be significantly more efficient, but the numbers you are citing here are so much more than I would have ever imagined. Evidently, it pays not to be bogged down by legacy systems. I've come across similar numbers when I researched for my Visa episode. I didn't bring them up because the business model is so different that I figured it's kind of unfair to compare that. And the value of those numbers is probably low, but still I'll cite them here. I think for Visa it was that over 150,000 cardholders come on every employee they have. Again, these numbers are less important than if you compare Nubank to traditional banks, but it shows you the pattern of how the less reliant you are on employees in the fintech and just general finance space, the better your margins and unit economics of your business will be.
They just need fewer employees to provide the same fundamental services. It's as simple as that. And that's because they've been able to automate so much of the process, and not in a negative way. They've built an app that is really intuitive to use and that obviously people like, and that just cuts down on so much of the back and forth and the complicated processes you might normally expect at a bank, which goes a long way in reducing headcount. And you can actually probably argue that they have a really beloved and trusted brand too, which I think plays into the fact that it's such an easy to use app. And that probably provides some advantages as well. Well-known brands are just going to have an easier time onboarding and attracting new customers, and they're going to have to spend a lot less on marketing due to that strong brand reputation that generates more organic growth. And that is something of a structural advantage for sure. Again, I wouldn't call that a true moat for them yet because it's all so new. It's such a young company. They've only been around for a few years. So we don't really know how durable that brand reputation is. And brand reputations can be destroyed quickly, especially for new companies. But you have to say it's a growing source of moat for Nubank over time, and built on what is really that foundational moat, the low cost of production advantage that they have.
I think reputation for a brand is always important, but if you're a bank, it's even more important. But at the same time, once you mess up any small thing, all that brand value and all that trust is immediately gone. Maybe on the financial risk of, we discussed it, like a fast growing financial business like Nubank, how can you make me feel better about that? We don't have to go through a bunch of historical case studies to know that when things do go bad at financial institutions, they can go really bad. And from an outside perspective, it just can happen so suddenly. Right now, the numbers look fantastic, but if we dig down into all the loans they give, who knows what might happen in a year or two, or even just 5 years ahead.
I totally agree. I'm not here to say there are no hidden financial risks at Nubank. I don't work there, and I'm not a bank auditor or even someone who otherwise invests in banks very often. So I'm not going to be the one who can completely assuage those concerns. And if the seats were flipped, I would be asking the exact same question. That said, if we look at what the experts think, Moody gives Nubank an investment grade credit rating in line with Brazil's other major banks. So clearly the credit rating agencies don't necessarily see any major red flags. And one of the things that really matters with banks, since we can't see their loan books and the risks that they're truly taking, we have to try to assess the bank culture. Are people being incentivized to do fraudulent things like Wells Fargo a few years back, where employees were pressured to create these unauthorized accounts for people? Or is there just a culture of excessive risk taking or not treating customers and employees fairly? And with Nubank, they really seem to be in a league of their own again. Their widespread adoption tells you about how beloved its services are. And we've already mentioned what a great leader David Velez has been. But even just when you look at Glassdoor reviews from employees, the company gets 4.4 stars, with 90% of reviewers saying they'd recommend working there to a friend, and 96% of folks there saying they approve of the CEO. So that might strike people as a strange tangent to go on when talking about financial risk, but how employees are treated and incentivized matters a ton with banks. And in this case, it does seem like Nubank has as good of a corporate culture as you could hope, especially given its broader mission to level the playing field for underbanked people.
I used to think it was a bit weird when people brought up stuff like open jobs on LinkedIn or ratings on Glassdoor. Kind of like the numbers don't back your story, so then you have to come up with something else. But since a couple of years, I see myself doing that quite often. As a supplementary thing, of course, but it can be very helpful. Since you hooked me on Reddit, I even see myself going through some subreddits every now and then, especially when it's about goods or services that I'm personally not aware of or that I personally don't use. In this case, you could go to the subreddit about Brazil and see what locals are thinking about Nubank, and perhaps you get to speak to some employees. I think, as you mentioned, if you want to figure out the culture, it just pays to be at the root, like talking to the employees, talking to customers. Since you and me sitting in the US and Europe, we have no clue what the experience actually is.
Yeah. My hope is just to try to get as many touch points as I can as possible to understand the business, which is something I always do, but again, is especially important in this case, given that, as you said, we can't interact with Nubank. But to talk more about whether Nubank does have these financial risks brewing beneath the surface, I should say that I mentioned earlier that big banks in Brazil charge interest rates on credit cards with APRs that can sometimes be north of 400%, or at least historically they did. And I can't even imagine the anxiety I'd feel missing a payment with those rates. And it's not that Nubank is offering considerably lower rates. In some cases they do, but really what they've done is cut out many of the other fees that banks charge. And as such, they've been much more transparent about how that interest accrues, and they've made their products more accessible to a wider range of people. So you can make a lot of risky loans and have a lot of people not pay you back, but if you're charging 200 or 300 or 400% APRs, you probably are going to make more than enough in interest from those who do pay to make up for the bad loans. And the question is really, are those traditional banks in Brazil, and to some extent now Nubank, just extorting customers with high rates, raking in profits simply because they can for the time being? Or are those the necessary rates that they have to underwrite the financial risk of lending to these types of customers? And again, I should say that Brazil's baseline interest rates, so they're equivalent to the Fed funds rate, is about 3 times higher than in the US because inflation is also much higher. So when you have a much higher baseline interest rate, that does ripple across the system, meaning if those rates are shocking to you, and they are very high, it's not entirely an apples to apples comparison across currencies and economies. That said, though, there are countries with higher inflation rates than Brazil that do not have 400% interest rates on credit cards. And the consumer lending culture in Brazil and interest rates there are just notoriously the least consumer friendly in the world, I would say, even with new banks up in emergence onto the scene.
Yeah, I think it's similar in Germany and the US, where most cards I see have APRs between 18 and 27%. Now, I think about what those high rates mean for people in Brazil. And sure, for everyone who defaults, if there's just 1 or 2 people paying 400%, they can probably make up for it. But generally, I just don't see it as a good business model. I mean, if someone falls behind on a small balance, it can balloon into something unpayable within just months. And if that happens, people can't pay, so they default. But instead of adjusting, banks use those high default rates to justify keeping the sky high interest rate. So that sounds to me like a vicious cycle. If rates were lower, wouldn't more people might be actually able to pay their debts, benefiting the bank and the entire system? I mean, I get how some people can make up for 10 or 20 people who default, but it still strikes me as an unhealthy way to grow and make business.
I agree with you. And my question is, the median credit card user in Brazil that much worse of a credit quality than their equivalent in the US or Germany? And I think to some extent that there is an answer that yes, they are, because of the cycle you mentioned here. If people simply don't have as much experience with banking and borrowing in general too, of course, that doesn't help. The point being though, and we haven't seen it yet, but lending rates will almost certainly eventually come down pretty dramatically as Brazilians build up credit history and earn higher incomes, and as there's new competition to come in and offer lower rates. And that could all hurt Nubank and offset some of their growth and earnings power by reducing the rates that they can charge. And as you put it though, that actually may not entirely be a bad thing if it means lower default rates. So to summarize, I actually do think it's a big risk for Nubank that as more fintech competition enters and the credit ratings of Brazilians generally start to improve, interest rates could drop much faster nationwide than default rates and hurt Nubank's net interest income. Or, and this would have the same effect, regulators might simply come in and try to cap the interest rates banks can charge on consumer loans, which is something they've actually already done in some ways. There was a new regulatory rule mandated last year that effectively capped credit card APRs at 100%. And yet, even with this new rule, Nubank had no issue growing interest income 50% year over year. So this is all clearly very nuanced, and there are kind of mixed and offsetting effects in different directions that can be hard to separate. If banks are forced to charge lower rates, that in theory reduces interest income. But again, if it actually results in more people being able to pay off their balances, then there might not be that much of a negative drag at all, as you sort of alluded to, Daniel. And again, I'm not an expert on modeling credit risk, especially not on millions of credit cards. But I think you could probably take two very simplified views of Nubank. Either you think they're underpricing financial risk relative to their peers or taking on too many risky loans as a percentage of their portfolio, and that's going to cost them eventually, if not cause their business to potentially blow up in some kind of worst case scenario, because they're taking on loans with just such high default risk that more established lenders aren't willing to do at this scale, who, after all, these traditional banks, at least in theory, probably understand the risk profile of Brazilian consumers better than anyone because they've been lending to them the longest. Or the other view, again, that's very simplified, is that there was, and honestly still is, an oligopoly in Brazilian banking, and large banks haven't needed to lend to low-income families to generate excess profits. So they haven't, and they really don't know as much as you think about underwriting lending to them. And Nubank is still charging high enough interest rates to probably safely cover those risks. And while Nubank has grown quickly, that is maybe primarily because their app is so superior, and they have just been structurally willing to lend to people with less credit history using alternative metrics to assess that risk that they're taking. And as such, they're not necessarily taking as much outsized financial risk as you might think, or at least as the bears might argue. And they actually have a reputation for now offering very modest lines of credit to people with limited or no credit history. So small credit lines is sort of another way that they've been able to hedge some of that credit risk. And I should say that the answer between those two very simple frameworks of understanding Nubank is of course somewhere in between. These are really famous last words to sit here and imply that just because nothing has gone wrong, that nothing will go wrong. And if I were to get really bullish on them, I would basically be going off of a lot of the work that others have done to try and assess the risks that they're taking in lending. And what we do know for sure is that Nubank has powered its ascent by doing something that Brazil's historically conservative banking titans never really had a stomach to do, and that is lend to low-income families. And at a high level, it's up for debate how well Nubank is handling that opportunities and also the risks that come with it. One other subtle risk I should mention is that when you primarily cater to retail clients and low-income clients, as opposed to commercial clients managing deposits for businesses, you can have a very sensitive base of depositors who, maybe in some sort of financial crisis, could panic and withdraw funds all at once. And that's a fancy way of saying that another one of the risks that Nubank may be more exposed to is a greater chance of being hit by a bank run by individuals and households who might be more likely to panic.
Do you have any data you can share on the risks they may be taking in lending?
I do have some notes for you just to make things more tangible. And for the sake of journalistic integrity, I should mention that there have been some alarmed reports over Nubank's lending practices. So there are certainly people who think this is all too good to be true. There was a Bloomberg report a few months ago, for example, that cited Nubank's percentage of 90-day non-performing loans, that is, loans where someone hasn't made a payment in over 3 months, and that had reached a new high at 7% of their total loans outstanding, which is considerably higher than the average of 5.5% for the wider banking sector, at least according to Brazil's central bank. And at the same time, the company's provisions for loan losses, which is the money they set aside to cover future losses, declined. So immediately, sort of a yellow flag. I don't really have a good explanation for that other than to say that this is the weak point in a bull thesis on Nubank and really does require careful attention. It can be really easy for banks to use loan loss provisions to manipulate earnings because if you set less money aside, your earnings today are actually going to look higher at the expense of your future results if you don't have enough money aside to basically cushion losses. And I'll just read a quote from that Bloomberg article. Fernando Fontoura, a portfolio manager at Persevera Asset Management, said, "The discussion on credit quality made us decide to follow this from a little further away." That is something to take note of. And I go back and forth here because I wouldn't say it's a consensus view on Wall Street to think Nubank is taking dangerous risks. But whenever things seem too good to be true, and especially for a financial firm that's growing so fast, alarm bells should go off. And yet also, on the other hand, I would argue that with any financial firm, you could probably find numbers to quote unquote freak out over. When you're growing loans at 28% year over year, it would seem like, though, that just leaves a lot of room for error. And when you layer over the fact that their chief credit officer left last year, there really is plenty of ammunition for bears to dwell on and worry about. And this has always been the downside of digital banking. It's just tempting to grow too quickly and take on risks you might not have even realized you were taking. And on the bright side, you can look at Nubank and also say, okay, they're trying to push toward lending to less risky demographics and doing more collateralized lending, where actually lend against an asset or a security deposit. And that secured lending portfolio grew 6x last quarter to $1.4 billion. And now that represents about a quarter of their total lending portfolio. So this has not been a subtle transition. They're very clearly trying to change the composition of the risks that they're taking now that they've hit a certain scale. And at the same time, they've also expanded into payroll finance, which again is this relatively safer form of lending because you're just lending in advance against payroll payments from companies that you know are almost certainly going to come through, because companies are going to have a big issue if they're not paying their employees. So in different ways, as concerns have started to mount about their past lending track record and their exposure to just how levered they might be to any kind of downturn in the Brazilian economy, which has historically had some frequent and big downturns, they've also made a very public push toward what you might call safer forms of lending.
What would be really interesting for me to see is, as Nubank has become more established and traditional banks have had to accept this shift and in the status quo, how have they responded to that? I mean, have they, for example, lowered interest rates on credit cards, or have they cut out banking fees to be more competitive with Nubank? And if not, maybe they can, because they have a higher cost structure such that they have to charge certain fees to maintain profitable. I'm guessing they have tried to offer digital services too, but clearly those haven't had the same adoption as Nubank. So tell me, what exactly did they do and did it work out?
I think this has all happened so fast that you could probably argue that they don't have a fully hashed out response, even still, based on the way they're bleeding market share. As we talked about already, interest rates on credit cards and personal loans haven't come down that much and are still very high by global standards. So the response from legacy banks has mostly been to offer no free credit cards like Nubank, and by trying to improve customer service with chatbots and by revamping the digital experience for users. New mobile apps, 24/7 support, real-time spending tracking, more transparent explanations of their interest rates, even some financial education initiatives, one-click freezing of cards, and just digitalizing many of their processes like opening accounts or card applications, that kind of stuff. And these processes have become so much less bureaucratic than they used to be. So it is a risk that eventually these legacy banks continue to close the technology gap and can pull customers back by offering higher touch services that a digital first bank can't really do. Recognizing that they can't directly compete with Nubank's tech stack, some of these big legacy banks have instead opted to just acquire fintech companies and try to build on what they've done rather than building something completely from scratch themselves. Nubank, I would think, has been a big wake-up call on the quality of their service since customer expectations have shifted dramatically in just a few years because of what Nubank has been able to do. And really the winner of all this competition ultimately are Brazilian consumers. It actually became very common for members of other banks to threaten to switch to Nubank as a way to get fee waivers. So I do worry that the end game here is a commoditization of financial services in Brazil, such that no bank is a winner in the way they are now and used to be. And kind of surprisingly, so given the degree of market penetration that Nubank has in Brazil, they have a relatively small share of Brazil's total banking assets, partly because they filled a void in the market by targeting Brazil's sizable population of underbanked households who don't have a lot of money, while traditional banks there have really continued to serve those high net worth cohorts and serve them well. That is starting to change, I should say. With Nubank has this new ultraviolet program that offers cash back and a travel portal that does cater to what you'd probably call wealthier customers and also charges monthly fees, which does sort of go against what originally made Nubank popular. So in summary, Nubank is starting to target those higher income demographics and is sort of fundamentally changing its strategy to do so. And it'll be really interesting to see how that shapes the next frontier of competition with these legacy banks.
Certainly. I guess many high net worth individuals just value the personal connection to the banks, but the upper middle class might be one that they can target, and they likely will target them through programs like Ultraviolet. What can you tell us about the marginal costs of each new customer relative to the value they create, especially now that they might target the upper middle class? I would think for a digital bank, those unit economics should look pretty attractive, especially compared to those legacy banks. They already have some pretty compelling operating margins of like nearly 25%. But if the unit economics are as good as I think they are, that margin could actually continue to go higher as the business scales.
It's a really good point. And due to having the cost advantages we've mentioned a few times today, the unit economics of Nubank's business do end up being compelling and can probably only become more compelling if they hit those higher income cohorts that you mentioned. And the way to think of it is that Nubank's average lifetime customer value relative to their customer acquisition costs is something like 20 to 30 times higher. Meaning that for every dollar of revenue a new client generates, Nubank might only spend a few cents to acquire them. That's primarily because they have such a massive referral program and get so much of their business that way, as opposed to having to do paid marketing or all the things that traditional banks try to do to entice new customers. And on that front, in the US at least, just think about Capital One and their cafes that they run. They literally run coffee shops as a way to ultimately bring in customers. And when I compare that with how Nubank has grown, it's just a considerably costlier way to attract business. And Capital One is, for the record, playing a different game in a different country. But I just to say that to make the point that there are different ways for banks to acquire customers. And Nubank has shown that it can do so very cheaply at a massive discount to what the average customer is worth to them. And it's not entirely a function of cheap acquisition, though. Those really attractive unit economics also come from significantly increasing their average revenues per customer over time, such that the lifetime value of the median customer is higher than it used to be. And from effectively cross-selling new products and just generally increasing transaction volumes as customers become more and more reliant on Nubank's offerings over time, the company's average revenue per active customer, aka RPAC, has risen steadily in the last few years. This is a really impressive stat, but for people who've used a Nubank product for more than 12 months, 60% have converted to opening a bank account with them. And related to all this is that Nubank customers don't leave. The churn rate is almost unbelievably low. We're talking about a few tenths of a percent a month, and that has resulted in a very loyal customer base with higher lifetime values because people stick around for longer and they tend to use more products over time. So from the company's earnings presentations, we know that active customers tend to increasingly rely on Nubank as their primary banking platform, use more services over time, as I mentioned, and as such, of course, their RPAC is going to increase over time too, which makes the business only more and more compelling. So you'll have to take my word for it, Daniel, but there is a real argument here for Nubank actually being one of, if not the most efficient banks in the world. And when you combine that with the explosive growth they've seen, just you get incredible results for shareholders, assuming that, and this is the big caveat, that the financial risks they're taking are at least in check or as conservative as you'd hope, which is a big assumption when it's difficult to truly verify that for ourselves. And management has said they actually think gross margins can rise another 15 percentage points over the next few years. And so, of course, that is going to definitely boost operating margins too. And I mean, I could imagine that operating margins might be north of 30%, at which point they really do look like a big tech company.
I know that when you started researching Nubank, you kind of pitched me on the numbers, and I've looked into them myself, and the numbers are just insane. Across the board, if you compare them to any legacy banks, not only in Brazil, they are so much better that I understand your feeling that there has to have something to that. It can't be that good without any hiccup on the story. But you just mentioned the margins, and to unlock even further margin growth, they are going to have to keep growing and growing as they basically are doing right now. And that way they could also get more of these scale benefits, which are part of the reason why their numbers are looking so good. So maybe on that point, it seems like a good time to discuss the different ways that Nubank could still grow its business. We know that the banking industry is a pretty regional market. Even the biggest banks in the world, many of the large US banks, have most of their customers, at least on the consumer side, in their home country. And that's because of regional regulation, its differences in credit risk, and even the entanglement of banks and national politics. And we've seen that in Brazil when the legacy banks tried to keep Nubank out using their connections to Brazilian politicians. Nubank never had that political edge or advantage. And as a digital bank, they might have it easier to comply with regulations as well in other countries. And even if the differences in credit risk might be less of a problem for them with all the extra data, there is still an argument to make that expanding into other countries could at least be difficult. In my mind, all of this could benefit them when they try to do this, but maybe you could talk a bit more about how you see them growing in the future and what part expanding into other countries can play.
Yeah. So we've talked a lot about Brazil, and there is probably an opportunity to move up the income ladder there, but that would also require a change in their strategy more fundamentally. So more interesting to me is that Nubank could really just run the same playbook in Mexico and Colombia, which are these similarly large countries. And in Mexico's case, it actually has a higher GDP per capita, while only 24% of the population use credit cards compared to 40% in Brazil. And again, if you combine Mexico and Colombia's population, it's about the size of Brazil's. So theoretically, they could double their customer base by just recreating the same success there, which is aggressive, but not crazy, given that these countries now have unbanked populations that are larger than Brazil. As of 2021, for example, over 50% of Mexico's adult population was unbanked. These markets just seem to be begging for fintechs like Nubank to come in. And of course, that has drawn in a lot of competition from new competitors, but Nubank certainly has some large-scale data and financial advantages working in its favor. There are probably thousands of fintech startups across Colombia and Mexico that are vying for control over what are very promising financial markets. So I don't want to make it sound like it's easy for Nubank to come in and just penetrate those markets, but they're certainly doing so from a position of strength. They already have 9 million customers in Mexico, for example, and I'll just take a moment to read something from David Velez here. As he has put it, over the next 10 years, we will continue to go after that hypothesis of testing this model really in more countries beyond Latin America. But this is not an easy model to internationalize, especially the way we do it to become the primary bank account of our customers. And according to the gentleman overseeing Nubank's expansion into Mexico, 20% of Mexico's adult population with a smartphone has already applied for at least one financial product through Nubank. So that is just so very promising and telling of what direction things are moving for Nubank outside of its home market. And for half of these clients too in Mexico, their Nubank credit card is the first credit card they've ever had. So the opportunity here goes without saying. And to maybe just invoke David Velez again on his dream scenario, he said in a call that, quote, "Nobody in history, as far as we can tell globally, no other global consumer retail bank has been able to build a multi-country platform that is extremely efficient and that has one code base that ultimately could give them a significant advantage in expanding." And that's what we've been building for about 18 months already, and probably have another 18 to 24 months, and is something that will continue maybe forever, is having a proprietary core banking platform that allows us to be in multiple countries and allows us to launch in new countries with relatively low investment. And if you want to be really bullish on Nubank, you could argue that they have a potential to take over all of Latin America at scale with low costs. And if anyone is going to do that, it's probably going to be them. Having this single software platform powering that business is just a huge leg up over their competition that probably lack the technical prowess and have tangled legacy infrastructure or just don't have the resources and scale and data that Nubank has.
This would totally change the regional aspect of banking that we've just discussed before, and that we also talked about in the Visa episode, which is an advantage that Visa has, that they don't really care where the bank is. And now Nubank could potentially do the same just in South America. Having said that, I know too little about the fragmentation of the South American market and the differences between each country, especially in banking. But based on Nubank's success in Mexico and Colombia, I would buy into that story. Just in Mexico, I've put the numbers quickly before we started the call. They account for 23% of Mexico's bank population, and growth in Colombia, while at an earlier stage, is similarly impressive. And if you just look at those growth numbers, that's one thing. But what we are seeing are all the other key metrics that currently look fantastic, but you could maybe tell us a bit more about how they matter for Nubank. What are the key metrics we should look at to understand a digital banking business like Nubank?
We always talk about returns on capital as being one of the core determinants of returns, but when looking at banks, that is actually not typically the best performance metric. I think you know that, Daniel, but I say that just for the audience. Since banks, almost by definition, use a lot of capital in the sense that you have a lot of financial assets via loans and liabilities in the shape of deposits, ROIC can be less telling of reality. And as a result, what we want to see is using their capital structure, what returns can a bank like Nubank generate for shareholders? As in, what is the return on equity? And for Nubank, it is, well, very, very good. Nubank's ROE last year was 28%, while for some of Nubank's biggest competitors, that return on equity is closer to the mid-teens, like Banco de Brazil at 15%. And if you look at a premier bank in the US, like Bank of America, their ROE is just 10%. And JP Morgan's is around 15%. So clearly, Nubank stands above local and global competition in terms of its returns on equity. And of course, the more leveraged a bank is, the more it can amplify ROE, but you also are increasing the risk of a blow up too. And on that front, Nubank isn't as highly leveraged in the sense of going out and making every possible loan as you might think. They have a loan to deposit ratio of about 40%, meaning that for every $1 of deposits they have, 40 cents is loaned out. And that is actually very low by global banking standards. A more typical number would probably be 70 to 80%. And so this does suggest they're not just blindly making as many loans as possible. If anything, you might actually say they're sitting on too much depositor cash and could be making more loans to optimize their earnings power. And I think in part, the explanation for that is, well, for one, they're growing so fast in Mexico and Colombia, they're collecting a ton of deposits from people who are opening new accounts, and they haven't yet started lending at scale in those new markets. And then also there's sort of this regulatory kink in Brazil where merchants in Brazil typically receive card transaction proceeds after 30 days, unlike in the US and Europe where there's sort of this near instant settlement that occurs. And this means that card issuers like Nubank fund customer purchases upfront, but don't need to send payment to the merchant acquirer immediately. And that gives them an extra 30 days of float that boosts their deposits and allows them to finance their growth more cheaply than other banks around the world. And we talked about this earlier, and this was the loophole that the big Brazilian banks wanted to change to crush Nubank. And obviously that did not come about. And now it creates a ton of float for Nubank that sort of distorts the loan to deposit ratio. But yeah, that's a summary of the loan to deposit ratio for you.
That's one of the idiosyncrasies of researching a bank, right? They have so many ratios that you don't usually look at for other companies. On the balance sheet, that can be the loan to deposit ratio that you mentioned, which is surprisingly low for Nubank. I think many of the European banks are deep into the 80%. And then you usually also look at the proportion of short-term borrowings just to show the fragility with respect to changes in funding conditions, or the liquid asset ratio to show a bank's ability to absorb funding shocks. And the same is true for the income statement as well, and the ratios that you look at. For example, when we talk about Nubank's operating margins, even this is calculated differently than how you would assess operating margins and profitability for a non-bank stock.
Exactly. Bank stocks, as you said, are a niche of their own, for sure. And with any bank, we also want to look at the net interest margin, which is a measure of how profitable the bank's core business is. And that is, to what extent are they lending at higher rates than they pay depositors? Net interest margin is calculated by dividing a bank's total net interest income, so the interest they earn on loans, minus interest they pay depositors, by the average amount of interest earning assets they have. And this matters because banks largely finance themselves with deposits. So that's borrowed money that they owe, and deposit rates are the costs of financing, which they use to make those loans with. So a bank that's lending at relatively high rates and paying relatively low deposit rates is going to have an above average net interest margin. And again, Nubank's numbers here are just extraordinary. Their net interest margin was around 17% last year. And I can't emphasize how massive that is. The global standard is something like 3 to 5%. And the Brazilian banking industry is probably on the higher end of that average. But still, Nubank's net interest margin is an anomaly, which I feel like is starting to be a pattern in this episode as we talk about just how excellent they are at seemingly everything they do. And that leads into a whole conversation about trying to adjust the net interest margin for the lending risks taken. We probably don't have time to get all the way down that rabbit hole, other than to say that in theory, they are, of course, taking greater risk to earn that higher interest spread because they're making so many consumer loans. And then the last thing we want to look at are their loss provision ratios, which again, we touched on a little bit earlier. And that does relate to the conversation on risk adjusting Nubank's lending margins. Because they're dependent on much higher risk lending than the average bank, they set aside about 13% of their total loan portfolio in reserves to cover losses, which is going to be typically higher than traditional banks. And that makes them sound more financially conservative. But of course, they have to set aside more funds to cover losses because, again, they're making more risky type of loans to less creditworthy borrowers. And there are a bunch of similar metrics to these that show the nuances of the risks that banks take. But I'd say, to go back to your original question, the net interest margin, the loan to deposit ratio, and loan loss provision ratio, those are sort of the key metrics that we need to understand for any bank. And we've touched on them a little bit here with Nubank.
With all these numbers and the ratios, I think if any one of our listeners has never researched a bank stock, and this is the first one they come about, it's incredibly hard to understand how astonishing all of these numbers are. They are best in class in pretty much everything what they do. And with all that said, how about you tell us how you approached valuing Nubank? There are so many risks you have to factor in, and I can assume it's just getting difficult. I mean, fast-growing young companies are always tricky to model. And then when you add in the financial risks of a bank, layered over with the currency and political risks of a company based in an emerging market country, I don't really envy the work you probably had to do to estimate Nubank's intrinsic value.
Thank you for saying that, Daniel. It wasn't easy, but it's not heroic work either. I do enjoy doing it. And so, I tried to model out Nubank's earnings and also get a feel for Nubank's operating margins, which I adjusted to include net interest income, net of the interest they pay on deposits. And I mentioned that because normally, as we touched on a minute ago, when we say operating profits, that usually excludes interest costs. But with banks, interest on deposits is their costs of doing business. So we can't ignore it. And interest on loans is our primary revenue driver. So we really can't ignore that either. And when projecting out Nubank's net profit margins and earnings per share, I used a 12% discount rate to bring those future profits into present values. And keen listeners will notice that this 12% discount rate is a few percentage points higher than the rate we normally use of 8% to value large cap companies like Nike or Visa or Alphabet or Airbnb. They're all based in the US. And I would say this is for a few reasons. The discount rate is like our hurdle rate. Think of it as the rate of return we need to earn to accept the risk we're taking. And so when investments come with higher risks, you should demand a much higher discount rate. And because a Nubank primarily earns its revenues in Brazil, which is an emerging market country, as we've said a few times, that comes with a number of risks. For starters, as we already know, the Brazilian real can fluctuate dramatically in value due to changes in Brazil's inflation rate and growth in its very cyclical economy. So you're dealing with an inherently more volatile currency. And when you convert those earnings in real to USD or euros, the same earnings from Nubank may not always be worth as much. Since 2015, the real has lost almost half of its exchange value against the dollar. So that's a huge headwind to fight against, assuming that trend continues. And if your USD earnings get cut in half every decade, well, you don't need me to tell you that you're going to need some really incredible earnings growth in local currencies to offset that. And the USD earnings are, at least to an American investor, ultimately what matter.
It's the ever same problem for US or European investors. And one of the things we also wondered when we listened to Buffett this year at the Berkshire meeting is he seemed a lot more concerned about currency risks than basically ever before. Mostly about the US though, but I highly doubt he wouldn't feel more uncomfortable with owning a bank like Nubank operating in regions with highly volatile and depreciating currencies. It's a huge headwind that many investors, at least in my opinion, ignore when they see a good company. But that headwind is so strong, it can easily turn a great investment into a mediocre one and a mediocre investment into a terrible one.
So you've got more significant currency risk, and sort of baked into that is higher political risk, where you're investing in a country that by most measures does not have a strong rule of law as US or Western Europe. And then we're investing in a young company in a sector that can carry serious hidden balance sheet risks. And all of that combines together for me to say, okay, we need to use a higher discount rate to value the equity of this company. As Motor does a really great job estimating in detail the equity risk premiums and country risk premiums for stocks and markets all around the world. And after viewing his estimates on Brazil's risk premiums, I landed on a 12% discount rate for Nubank. And people try to make this an exact science, and it's not. And you may feel like a different discount rate is necessary, but this is just what I thought was appropriate after digging into the risk premiums typically calculated for Brazil and their equity markets generally, and then also for the banking sector there. And so when you're using a higher discount rate, that is going to reduce the future value of earnings more, but also raises your expected return from a given price target. And then on top of that higher discount rate, I also added in a 25% of margin of safety from my estimated fair value of Nubank stock. So between the high discount rate and the baked in margin of safety, That's how I get to a target buy price where, assuming we felt comfortable with the story and risks for Nubank's qualitatively, then I would recommend buying the stock when it's at least near or below that price range that I get.
And what is that price range that you get? Do you have a detailed price target or is it a broader range? What did you come up with?
That's a big question, isn't it? Well, I should say that at every corner, I did try to be as conservative as possible to acknowledge everything I don't know about the risks that I'm taking here as someone who doesn't otherwise have a ton of experience with Brazil, Nubank, or even financial stocks. And my model, for example, has Nubank growing quickly, but still below the range of estimates I've seen from analysts projecting their 2029 sales figures. And I accounted for some improvement in their operating margins due to the attractive unit economics and scale we've talked about. But I also only accounted for really only 1 or 2 percentage points of operating margin improvement, whereas some of the bulls out there are arguing for margins to rise by as much as 5 or 10 percentage points. And whenever you model out a company that's growing earnings by nearly 18% a year, as I did, it's hard to say that you're being truly conservative. But relative to the company's recent track record of growth, the very large runway ahead of it in Mexico and Colombia, and then analyst projections, I would say my assumptions are fairly tame. And on top of all those caveats, I also added an implied exit multiple of about 22 times earnings, which would be a pretty significant compression from the company's current valuation, where it's trading at about 30 times last year's earnings and was trading at as high as 50 times last year's earnings just a few months ago. So again, being somewhat conservative, or at least not overly aggressive in my assumptions, I get a really wide target buy range, which is sort of a cop-out because this is such a hard company to value. But I would say between $10 and $12.50. I think that's really attractive to maybe build a position. And at the top of that range, I would really only want to nibble on the shares, probably 1 to 2% portfolio position. But then at the bottom of that range, once you hit $11 or lower, that's when I would say, okay, I'm starting to see that the risk reward here starts to look very attractive, such that I would be inclined to make Nubank a larger portfolio position, or at least make a more aggressive bet, depending on how comfortable you feel with it, Daniel. That said, I should say, when I talk about making a bigger bet on them, I don't think we want it to be the size of like an Alphabet in our portfolio, because even with the higher discount rate and the margin of safety, this is still a company where things could just go very badly. Things could blow up in a different way than they could for some of our other portfolio companies. So there's just a substantial risk to the downside. As for example, if their lending habits prove to be a lot riskier than we think, or there's just some sort of really massive economic downturn in Brazil, which wouldn't be unprecedented, then that could really be bad for their business. And that's why I say we need to hedge our position size accordingly. So in the middle of that range at around $11 per share, just for context, I get an estimated rate of return that's implied at about 16% a year, which obviously we're not guaranteed to get that estimate. Reality rarely matches estimates, but I think that's probably the highest expected annual return over 5 years that we found for any company yet. And current prices are a good bit above that, but still, I think that does tell you about just how much potential there is with this business.
I feel though like you're wavering back and forth here a bit. Like on the one hand, the valuation is attractive, or at least the growth prospects are outrageously good. And there's a very promising story to be told about the company's history and future. And yet you kind of seem reluctant to really commit to recommending it. Why are you not sure about your pitch here? Or am I wrong about my feeling here?
I think personally, I have a lot of conviction in it. As you said, 5 years, is Nubank going to be worth dramatically more? My gut instinct would be, yeah. But as we're talking about it here, I think I've maybe just read too many financial history accounts about bank blowups that just generally I'm nervous about owning any bank. And the fact that this is such a fast growing digital bank in a distant country gives me more pause to just be humble about what I don't know. So that's why I'm not banging my fists on owning something that I do think is, it's a great company from what I can tell. So the range of possible outcomes here is probably wider than any company we've looked at. And that even includes Reddit, which is probably the most speculative bet we have in the portfolio at the moment. I mean, it's not hard to estimate Nubank's value to actually be dramatically higher than I did. As just an example for that, for anyone who doesn't believe that I'm being conservative, I have Nubank's monthly RPAC at around $15 in 2029. Yet Nubank's more mature clients today are already worth $25 in RPAC. And wealthier clients at traditional banks have historically had RPACs north of $40. And I'm saying RPAC a lot. It stands for average revenue per active customer. And then those are monthly numbers. So as people come to rely on Nubank more for services, and as Nubank attracts even wealthier clients, it's not that crazy to say that their average RPAC could ascend toward $20, $25, or even $30, matching some of their more mature client cohorts that they already have and some of the wealthier customers at Brazilian banks. For example, at a $20 RPAC, which is a number that a lot of analysts are kind of marking as a reasonable target for Nubank to get to, then my estimate of Nubank's intrinsic value probably jumps by about 40%. And at current prices, you'd be talking about as much as a 20%, 25% implied annual return from those levels. And I would say to anyone wanting to value Nubank, don't just focus on the number of active customers they have, but again, you really have to think about the RPAC and how much revenue they're going to be earning per active customer monthly. And just by betting on their RPAC converging with their most loyal customer cohorts or some of these other banks, you're already talking about a business that in a base case has significant room for growth without even talking about continued expansion of the customer base. And if we wanted to take maybe a small bet on them, Daniel, maybe 2% of our portfolio at current prices that are kind of between $12 and $13 per share, where at least according to my model, we're still getting an expected return of 12 to 13% per year, and then keep a close eye on the position and revisit it frequently. I would be inclined to do it, and maybe we'll end up getting an even better price than that. But if you're not on board with it, I'm more than happy to set this thing aside and kind of watch it from the sidelines too. It's something that I'm not sure I could totally sleep well at night with. I feel like there's a lot of work left to do on this name. Like, we're not anywhere close to be done with the process. And maybe the reason to take a small position in it would be to really just ensure that it keeps our interest so that we keep pushing ourselves to dig deeper and deeper into it. And if we continue to learn more and like what we find, and we like the prices that we're able to get the stock at, it could build up to a bigger position over time. But I've rambled enough here, Daniel. I'm tired of hearing my own voice. So why don't you just tell me how you're feeling about Nubank?
I think the advantage that we have in establishing smaller positions is keeping them on the radar. We've talked off script about Nintendo, which is a company we covered quite a while ago, and it went up 30, 40% since we covered it, and we just didn't buy into it at that price, although it was very close to our intrinsic value target. And sometimes you just miss the opportunity if you don't take it when it's there. And Nubank is a company that has been extremely volatile. It will keep being extremely volatile. So there's a good opportunity that you can buy it at cheaper prices down the road. But if we're talking about a 2% position, I would feel more than comfortable adding it to the portfolio. What makes it a bit hard is that all their numbers look outstanding. If you just look at their numbers, if you model them out, as you said, you've been quite conservative, at least as conservative as you can be with such a company, and the numbers look fantastic. The only problem is that the downside you have with a company like this is asymmetric in terms of lots of upside, but this could blow up at some point, and then you're just left with this zero. And that's fine if you have a small position in it and you believe that the upside can balance out that risk, but it just feels like there's a natural limit to the position size you can give to a company like Nubank. We've talked about other portfolio companies, and you've mentioned Reddit, where even that company, although the business model is not yet as proven as Nubank's business model is, feels like there's less downside just if you compare to other peers like Snapchat. The company isn't making any money, but it's almost as valuable as Reddit. And with Nubank, while the company is making money, while the expansion plans look like they could succeed and there's huge room for growth left, there's always the opportunity that some of the loans are not as good as you think. They cannot cover them. The company could blow up. And it's something that you and me from the outside could never see coming. And that risk is something we have to assess, and we cannot model it out. Even though you tried raising the discount rate, you put on 25% margin of safety, it doesn't really show us the probability of it going to zero. So I'm completely fine because I love the company, I love the business model, and it has a proven track record to start a position, let's say 2% for now, see if we can average down over time, how the company is doing. I'm totally on board.
I think the other thing I should say too with Nubank is this is a company, we usually look at a 5-year time horizon, and this is a company where we need to look on a 5-year time horizon, because once you start thinking about 10, 20 years out, I do think that there is this trend of commoditization of banks generally, right? Like ultimately, a credit card is a credit card. How differentiated can a credit card be? And a savings account is a savings account. And so we kind of know that in the really long term, Nubank is probably going to converge to being a more average business. And yet there's such a wide runway across the rest of Latin America that it's a business I think we could do well owning for the next 5, maybe 10 years. But we should add that caveat that, sometimes when we try to buy companies, this is something we want to hold for the rest of our lives. And maybe my feeling will evolve with Nubank and they'll just continue to be excellent and excellent and excellent for years to come. And then, of course, this is a business we want to hold indefinitely. But at this moment, I kind of had that caution with Nubank where I think, okay, on a 5-year time horizon, truly, this is a business that has so much room to improve and grow that it makes sense to own, but it's not something I want to hold and give to my kids in 30 years, right? We kind of know that it's going to eventually trend toward much more average results. And it's not always going to be the stellar business that it is today. So with that caveat, Daniel, I agree. Right now at the time of recording, the stock is trading around 1250. So it's kind of at the top of the range that we had talked about buying it in the model. But at the same time, the numbers in the models are just rough guides that kind of help us ground our thinking into reality. And so if Nubank is as good of a business as we think it is, and we've been as conservative in the model as I like to think I have been, I'm not losing any sleep if we buy it at 1260 and that's 10 cents over the top of our range. That's not really exactly how we want to invest. We don't want to be strictly bound by these targets and not own a really great business because of a few cents in the model. So we're being the first to say we're buying this, we're nibbling on it at the top of the range where we find it really attractive, and we can build that up, as you said, as it goes down. So with that said about Nubank, why don't we wrap up with a preview of what you'll be pitching for your company next week as an addition to our intrinsic value portfolio?
Sounds great. I mean, for my hints, I thought about some, and I think they're good in terms of some people can guess it, while others might not get it if they don't know the company yet. So my first hint would be that without my next company, all the big tech giants that we discuss often couldn't do their business. They just couldn't do what they're doing if they don't get what my company produces. And then both you and me, as well as pretty much all of our listeners, I can say that with a high degree of certainty, have their products, although most of us are probably not aware of it. And then last but not least, it's a company from a country that we haven't yet covered. Nubank was such a company as well. And the next one will be an international company again.
Okay. I don't know what it is. So I'm curious to hear maybe offline what the pick is, Daniel. And I'm certainly looking forward to it. So I'll leave everybody with a quote from Li Lu, who tells us, being a value investor means you look at the downside before looking at the upside. And with Nubank, we really need to think about the downside before we get swept away by all the growth prospects that we could get really excited about. So that's a good reminder for us. We will see you all again back here next week.
Nothing is more convenient than ordering today and having it delivered tomorrow, as you and I know best, or at least in the next 48 hours. And that's basically the Amazon Prime promise. Amazon has invested tens of billions of dollars into its logistics infrastructure to deliver on that promise. And by now, some 20 years later, Amazon Prime is so much more than just fast and free delivery. It's this vast ecosystem speaking to every customer out there. I mean, if you want to listen to music, it's Amazon Prime. Movies and shows, Amazon Prime. Thursday night football for you, Amazon Prime. Champions League for me, Amazon Prime. More than 230 million members are subscribed to the service. And last year, Prime alone generated about $40 billion in revenues.